All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Before we go look at the challenge, let's look at a few earnings reports here. Let's start with IBM. IBM, a report that I don't think you can say is a great report, but we've talked about IBM for a while. All year here, talking about how there's value here. The Red Hat acquisition is helping to drive some revenue growth. And more importantly, expectations are on the floor. And so they don't have to do anything spectacular to really perform well. We are seeing money come in after this earnings report, rightfully so, in my opinion. And a stock where, you know what, keep your eyes out. We're headed back to 200 here on IBM. And, this thing has had some splits. So, it's not there now, but it's traded at 200 several times in its history. And, for a company that's been mired in a lot of problems and some mismanagements, I think we have seen the company turn the corner here in a very big way. It is breaking out here from a short-term consolidation, and you can see the multi-year consolidation that is in play here on IBM. So you know where I stand. I'm very bullish IBM. But it's not one of those, feel good, everything out there is bullish on it type of stories. And it hasn't been, it's not going to be. But it is one of those stories where, one of those just kind of safer places for investors to find. And one that is starting to show signs of turning the corner. And if they are turning the corner, they have a long way to rise here. So, very solid report out of IBM, in my opinion. Though we can find some holes and some flaws in it. Like we can anytime. Netflix. Speaking of a different company than IBM in terms of expectations, right? And Netflix here, subscriber growth missed. Subscriber numbers missed. This is, look, it's one where I went through it. I went through the numbers. I went through the commentary. I think if you're a long-term bull on Netflix, you only have more bullish stuff to look at. It's a phenomenal story, right? It's an absolutely phenomenal story. But every pullback in Netflix, major pullback in Netflix has been driven by one or two things. First thing is a market pullback, right? And that's kind of what drove it late last year. And the second thing that's caused Netflix to pull back historically is a miss in subscriber growth. And they missed in subscriber growth. So they're pulling on back. It's one of those where I don't expect for investors to forgive that right away, although we have a lot of analysts defending it here this morning. But I don't expect for the real money to step in a big way and buy it back up in spades on this dip. I do expect that it's like any big earnings gap down. We see the same pattern play out over and over. And what is that? Gaps on down. Sometimes it'll rebound a little bit, but then bleed to a new low. Sometimes it'll push to a new low and then rebound a little bit. But, in all, there's another down that's going to come over the course of this quarter, and then it'll probably rally back to this level before the next earnings report. And, it's one of those where I've already noted Netflix in my notes that I want to be an owner of Netflix heading into its next earnings report. That's when I want to be an owner of Netflix, provided the story doesn't really change all that dramatically. So IBM, Netflix, two of the bigger earnings out there. We have seen UAL, we've seen UNH, we've seen a bunch of earnings from different other companies, Philip Morris. For example, but it's one of those where earnings season is coming in as expected. I don't think we're seeing a lot of big surprises for investors, and I don't expect that we will. Right, and it's one of those where if you go and listen to Honeywell and what they talked about and everything else, it's it's positive, but does it justify the valuations? Right? It's difficult to justify some of the valuations, especially when any kind of miss has kind of the same blanket type excuse associated here with it. Okay. All right. Let's go take a look at the challenge here. We have two positions on the board, Bank of America and Target. And entered Bank of America yesterday on the buy signal. And, it just proceeded to rip on lower into the close. Sold off, about 35 cents. Wasn't pretty. And it's in a really interesting spot right now. What do I mean by that? Well, the sell-off yesterday actually destroyed the trigger. Right, and that's just one of the things that's going to happen because of the times that we are trading. Right, the 10:30 a.m., the 2:30 p.m., and so it destroyed the trigger. The sell-off destroyed it, but the trigger is back here this morning. Right, and so the trigger is in, and the bullish signal is in. We're getting that 3-7 crossover to the upside here this morning, but we are already in, so I'm not looking to buy more or anything like that. But 96 cents is the mark on the option here. So down 300 there on that. 30 contracts, down 10 cents. So makes sense there. And then we have Nike. And Nike here down 9 cents, 8 cents. Or excuse me, not Nike, Target. I said Nike yesterday as well, right? And I swear I'm not in Nike. I do not have a position on Nike, but I do have a position here on Target. Now Target's in its auto exit time area. We are seeing a little bit of red on the option, though the stock price is up compared to what we bought the option at. So I'm going to go ahead and hold Target again here this morning. And again, like I said in the close yesterday, this isn't something that this isn't something that's going to make or break the challenge. It's not something that is going against the rules in any way, shape, or form. It is something I could easily exit, something I could easily stay in, and I'm going to opt to stay in. And one of those is because we don't have any new signals on the board right now, and I want exposure. I want to be in. I want to be playing. I don't want to be, all cash sitting on the sideline or, one position here. I do want to be in. Now, that could change here this afternoon as we see some things kind of setting up, and I titled this video, an oddity, not a rarity. What does that mean, right? And we are seeing something very odd this morning, but it's not something that we haven't seen many times in the past over the last 3 years of testing the trade algorithm and how these signals come in and how these signals play out. So if we go to our watch list, right, and I'm just going to pull up a simple scan here. Again, this isn't the challenge scan, but it does show the 3-7 crossovers, right? And if we go out and we do a bullish scan for upside 3-7 crossovers this morning, we have Bank of America, right? Okay, great. No big deal. We expected that. We saw that. Great. But if we go look at downside crossovers, right, where the 3-day moving average is pushing below the 7-day moving average, well, our list is quite large. In fact, it's a little bit smaller than it was on the open. We've seen some of the stocks on this list rebound, but we have 10 stocks here on this list. There were 13 earlier here today. And you said, well, some of these, they have to trigger a bearish signal, right? I mean, come on, all these downside 3-7 crossovers, we have to have a bearish signal somewhere, but we don't. Let me show you what they look like, right? And while the 39.1 stochastics does not come into play when, in terms of a trigger, right? In terms of, hey, is this stock triggering or is it not? It is something that I have and have used on here to kind of help you understand the concept of it. This concept of, hey, if it's trading near the upside of its range, above 50 here, chances of triggering bearish are minimal. If it's trading below 50, the chances of triggering bullish are minimal, right? And we've seen that, hey, we've had some bullish triggers where the Stoke 39.1 is about right here. So, it's not an absolute. but it is a good visual way to kind of see it. And so if we take a look at these 10 stocks that have the 3-7 downside crossovers on them here today, almost all of them are above 80 on the Stoke 39.1, right? And here, let me pull it over. Let me pull the list over there so I can just go through these. But we have Amazon. We have Caterpillar. Look at the 39.1. Look at where it sits, right? We have Disney, 39.1. Where does it sit? We have MGM, right? We have Nike, right? The real Nike, not the Target Nike. We have UPS here, right? We have Valero. We have Vulcan Materials, which had a 3-7 cross on it yesterday. Didn't qualify as a signal. Now today, 3-7 downside cross. And then the only exception, the only stock where it's not up above 80 is Verizon, right? And we have seen Verizon cross over 3-7 upside, 3-7 downside. It's like every 2 to 3 days it has a crossover as it's been in this consolidation. But not a single one of these are triggering bearish, right? And I mentioned this is an oddity, not rarity, right? And this is something we have seen before. So what does it mean? What do we pull from it in terms of understanding? Well, something like Disney, right? What do we know? Well, we know that, hey, in order to get an upside signal, we need an upside 3-7 cross. Well, for that to happen, we need the downside 3-7 cross to happen, right? The times we were able to go in and trade Disney for the challenge, right, it had gone through one of these types of periods where just a little pullback. Not a big trend, right, which is what the challenge algorithm's looking for. Challenge algorithm's looking for something like this here in December, a big trend. It's not looking for the mild pullback, right? It's not looking for, what has been a mild pullback here for Disney. And I know those of you who are weekly option traders or, all of that, you're going to have different definitions here. But from a swing trading challenge standpoint, these are mild pullbacks, right? Well, so what does it mean? Well, we're seeing a lot of the best stocks out there going through a period right now of just simple mild pullback, right? Just simple mild pullback, nothing too dramatic, nothing too earth-shattering, just kind of mild pullback. And ultimately, could they be bigger pullbacks? Sure, they could. But what we tend to see is that these types of pullbacks ultimately set up nice little buy opportunities, right? Now, when are they going to be a buy opportunity? Well, I don't know. I don't have to sit here and try to pick the bottom and try to say, well, you know what, today it's down, it's not going down anymore, it's going to go up now. I don't have to, get into that kind of silliness. What do I wait for? The next 3-7 cross, and if it triggers a signal for the algorithm, boom, you will see me trade them and be in them for the challenge. And so, we have a lot of these stocks that just have not been in very tradable, buyable areas for a while. Starting to get some downside 3-7 action, which is what they need to set up for the next potential signal here. Now, we could get something like, where Disney just goes straight down from here, right? Where it just tank, and it's down here to 112. What's going to happen to the Stoke 39.1? It's going to come all the way down here to 20 and below. And the next 3-7 crossover, it's not going to be a buy signal, right? The only time the next 3-7 upside signal is going to qualify as a bullish signal is if it is a shallow, mild, just kind of normalized pullback. If it materializes into something much more major, then we will not see a signal come in. And, this is one of those things where when we're developing the algorithm, we had to just basically take out tops and bottoms and say, you know what? When a stock hits a new high and then has a downside 3-7 crossover, that just can't be a signal. Just can't be a trigger, right? We saw it right here, right? Where, it just can't be a trigger. Yes, the stock drifted lower, but the implied volatility on the entry is relatively high. and most of the time you just get clobbered in time decay and a trade that just kind of goes nowhere. That's the majority of the time. Now, occasionally it will have the dump, right? That is a risk factor, and it's an elevated risk factor, but it is not a probability or high probability there with it. So we're seeing something fairly odd. We don't see it every day. But it's not rare. We've seen it many times over the years, over the last 3 years, and looking at the data set. And it just simply means that a lot of the top stocks are just in pullback mode. They're kind of normalized pullback mode. And, yes, could it turn into something a lot steeper and a lot more ferocious in terms of a sell-off? It certainly could, but it's also the precursor that is needed to get an upside signal and to be able to trade that stock ultimately higher. Bottom line, don't have to predict when that's going to happen. You can wait, react, go trade it, and have some fun there. Thanks for hopping on. Have yourselves a fantastic day. We'll talk to you this afternoon. Take care.